This is Mastering Your Wealth with David Gagnan, the podcast.
Well, it looks like Major League Baseball is stepping into the world of prediction markets. Fans will now be able to place bets on outcomes of games, seasons, and even standings. So let's build our own little, retirement prediction board. If MLB can do it, we can do it too, David. So if we had to post odds on the future of retirement, what would be on that board?
That's a great way to frame it because retirement planning isn't about predicting outcomes. It's about preparing for the most likely risk. And if we built a real retirement prediction board, here's what I'd put at the top. Will retirement happen later than planned? And this is one of the biggest risks because people assume they'll retire on their timeline, but life gets in the way. People have health issues, job loss, family responsibilities. I've seen this over and over again over the years. Sometimes you just can't predict all these variables that might change your path. There was a man that he was planning to retire at 65. We built a contingency plan at age 61 just in case he lost his job prematurely before his ideal retirement age of 65. Another thing we also want to take a look at is, will inflation change what comfortable means for some folks? Because inflation doesn't feel like a headline, it feels like a lifestyle erosion. And it happens gradually over time because we can see in the recent years how groceries, healthcare, travel costs have gone up significantly. They all rise at different rates. That's why when we look at this and these variables that are hard to predict, we want to build into the plan growth into the portfolio so we can hopefully offset some of those rises in prices and inflationary pressure on your money. We want to have flexible withdrawal strategies and income sources that adjust over time, because sometimes we can build into the equation of your income flow things that will go up with inflation. There are opportunities to do that. Social Security does give you some cost of living adjustments, but there are some other tools that we can use to build in increases gradually over time to help offset some of that inflation. The other thing is, will market volatility hit at the worst time? And it usually does for a lot of people. Worst timing is early in retirement when withdrawals begin. And a lot of people are pretty vulnerable to that if they're relying on the market to produce their paycheck. So what we'll do is we'll create guardrails on the income plan. And so we want to have some money in there that's not tied to daily markets. We want to have some cash reserves because surprises come up and you want to make sure you have access to cash and be able to get it without taking losses on it. So you want to have something that's pretty stable and predictable. We'll set up structured withdrawal plans, because when we do planning, there's a way we can build structure into your withdrawal and income plan so volatility doesn't turn into a permanent damage. So you can see, this is just a couple of variables that can impact the retirement. Taxes and inflation is a big thing, but Social Security, will that change? People are worried about that. Lifestyle that could be impacted by change in health, which can cost you money out of pocket. So, there's a lot of things that we have to take into account when we're doing planning and stress test a plan for some of these events that may occur. Maybe they won't, but you want to have a plan that can show you where you go off the guardrails. What is your spending capabilities and in different environments? And so I think planning is so critical for people to have done, and yet very few people are doing it. They're saving money and they're hoping for the best, and they draw from it as they need it into the retirement. And they're really not aligning their money in the right places to create a really good, predictable income plan. So I think people really should seek professional help if they're not getting a second opinion on these decisions that they're going to make in retirement.
Absolutely. And again, the good news is David's got over 40 years of experience here, folks. If you want to call in, get those questions answered, we can set that phone call up for you as well. You can do a Zoom. You can come in the office. If you already have a plan put in place, you can get that second set of eyes looking at it as well. Or if you're in the beginning stages, this is a great opportunity to find out, okay, how do I get started on this journey called retirement? 203-872-0009, 203-872-0009. You talk about people accumulating and spending. Well, there's an article on moneywise.com that said if you are worried about not having $1 million before retirement, it's okay. You might still get there after you retire. So it also points out in a new survey by Northwestern Mutual that states a lot of retirees are spending really only 2% of their savings each year. And that withdrawal rates, assuming the market cooperates, I mean, your money could actually double. What's your thoughts on this?
Well, the math behind that idea can work, but the real question is whether it works in real life. If somebody is withdrawing just 2% and markets perform well, their portfolio could grow. Now, but that scenario depends on several things going right. Strong market returns being one of them, controlled spending, good health, no major unexpected expenses. And that's where the theory starts to break down, because I've seen both sides of this. I've worked with a client a while back who was extremely conservative with her withdrawal. She barely touched her portfolio because Social Security covered most of her needs. On paper, she was doing everything right. Her account continued to grow. But here's the issue. She wasn't enjoying her retirement. She had built the plan to last, but not to live. She had, if she were to live her lifestyle, to do the task or the bucket list things that she wanted to do in retirement, that would be a different price tag. She wanted to travel, but she kept holding back on that. And on the other side, I've seen clients assume markets will cooperate, and then reality doesn't match expectations. So a few poor early years in retirement combined with withdrawals can quickly change that outcome. The math can work, but we don't build plans around if everything goes right. We build them around what if things don't. And that means defining a sustainable withdrawal strategy, which is very important. Structuring your income sources, whether it be Social Security, annuities, your investments. Building flexibility into your spending is pretty important. And stress testing under different market scenarios. Because nothing is good. You'll never be able to predict all the variables that could impact your money, good or bad, right? So come in today if you want to get some clarity on how things look going forward. We can do a forecast analysis to see what retirement might look like. And that is a great exercise because we might see things in the future that you don't see coming that might be a problem that will allow you to have time today to fix it with a good investment strategy aligned with your income needs.
The best part, guys, this is complimentary. 203-872-0009. 203-872-0009. Again, that website, masteringyourwealthradio.com. You know, David, we know we have lots of folks listening. They tell you when they see you around town, they call and say, I love this part of the show, and here's my question. And so we know we have a really big audience out there. We appreciate you guys very, very much. It makes me wonder, okay, so they are obviously our loyal listeners, right? They call in, they come to see you. But what makes you different? What makes you stand out with your approach and how you plan for retirement than the guy down the street or those big buildings we all know?
I'll tell you, we get a lot of calls from people with advisors, but they're calling us because they're not getting the answers to a lot of other things that will impact their money, such as how do you optimize your Social Security? What is the best strategy for that? How do you optimize your pension? How do you do real forward-looking tax mitigation planning? So when you're working with an advisor, you need to know what their focus is, what they really are helping you with your financial decisions. And a lot of them are investment people or annuity people. And they're not looking at all these other financial decisions that are extremely important that need to be assessed and evaluated so you're building efficiency in all these different areas. And so what we do is we do planning first and advising on how to invest after the fact. Because if you're making your investment decisions without a strategic, comprehensive plan that's looking at all these moving financial variables, you're likely not putting your money in the right places for your plan. And so comprehensive planning, tax planning is critical, and I think that is really the starting point people should work off of, a plan. Your last conversation with anybody should be where you invest your money after your plan's done. And so we're independent. We're objective. My background's taxes, being a CPA, and that's where we can create a lot of value. An advisor should create a lot of value beyond how they're investing your money in all these other areas where people make costly decisions that are in their blind spot. They don't even know they've made them until we point these things out. So if you want clarity, you want real planning, give us a call.
And again, really simple, guys. That phone number is 203-872-0009, 203-872-0009. Remind you that it is complimentary to sit down with David one-on-one. Don't forget that website, of course, masteringyourwealthradio.com. You know, when you think about it, the 401k really took off back in the 1980s. Congress created it as a way to defer taxes on certain income, not as a primary retirement plan. But for many Americans, that's pretty much exactly what it's become. So is the 401k really dead? Yahoo Finance asked Charles Payne on Fox Business.
I don't know that it's dead. I will say, though, that the 401k hasn't lived up to the hype. And I think that's one of the problems, right? And every year they come out and they'll say we have this many 401k millionaires, right? And it sounds like a huge number. Cool. Then you say, well, how many people have a 401k? And it's like 0.03% of everyone with one. So the promise was that if you just put this money in, it was going to end up being worth a lot of money. And I don't know that it's dead, but I think people have to approach it differently. And I think they're starting to, particularly like the 60-40 portfolio. I think that's a huge mistake. On the 40 side, 40% in bonds, I think, is just a massive mistake at this point.
All right. Well, listen, he says a lot there in that clip, so I want to break it down here. David, what do you think about this? I mean, do you see the 401k getting a revamp? Have you heard of people talk about these pain points? What do you think the changes should be?
The 401k, as well as the IRAs, they were actually brought into our system in the mid-'70s. And here's what the government was seeing. What they were seeing were the working folks were not saving enough money to have enough of a nest egg to have a good retirement or a comfortable retirement. They were seeing that people weren't saving enough for retirement and only falling back on Social Security as a retirement plan. And that was not what Social Security was intended for. Social Security was there as a supplement to help somebody with income in the retirement, not as their main source. So what they did was they came out with these pre-tax retirement accounts, 401ks, IRAs, SEPs, and so on. So they needed to give folks a perceived tax break or a benefit in their mind. And that's meaning that they put the money in pre-tax. They are going to cut down their tax bill for what they put in from each year of their working. But then that money is growing and compounding taxes, not only on the initial deposits, but all the growth for all the years up until they get to a point when they take distributions. Now, that was giving people the incentive to save more money than they normally would. And it made it easy for them to save because now it's being deducted from their weekly or monthly paycheck. And it was a way to get people to have consistency in savings and have some more money when they got to the retirement years. Now, I don't think the 401k is dead, but I do think the old way people use 401k is kind of incomplete. For decades, the retirement message was simple. Put money into your 401k, invest, let it grow, and one day you'll retire. But that leaves out the most important part of the retirement. How do you turn that balance into a dependable income? And that's where income planning is so important. We just had a discussion about that. The 401k is really, truly an accumulation vehicle. That's really the main purpose of it. And it has limited investment choices because if you look at the investment environment out there, there's so many incredible things that you could take better control of how your money gets managed and some of the features that are available outside of a 401k compared to inside of a 401k. Now, it's very good at helping people save money on a tax-deferred basis while working, but it was never originally designed to be complete retirement pension replacement. So the old pension system gave retirees a monthly paycheck for life. That was having a paycheck for life from a pension plan. And then a lot of companies eliminated their pension benefit plans and now their contribution plans, such as these 401ks. So the 401k gives people an account balance, and that means the responsibility for investment risk is on them. Withdrawal risk is on the owner of that 401k. You have longevity risk, tax risk, market risk has shifted from the employer to the retiree. And so that's the big burden right now with 401ks. And the other issue is the so-called safe part of the portfolio. So for years, people would put a portion into bond funds, which they thought would stabilize their retirement portfolio, but it hasn't worked out that well. If you go back to 2022 and you looked at a 401k plan, because I've done a lot of an analysis, a lot of people were split between 60% in equity funds, 40% bond funds. Those two asset classes did very poorly in 2022. Bond funds lost money because the interest rates moved. And people were kind of confused by that because they didn't think bonds could lose that kind of money. And up to that point, the yields were really low. We don't use bond funds. We use bond fund alternatives, which have much higher yields for the same amount of risk or even less. And so, that's how we enhance income planning, because we can find higher yield tools that the wealthy people use. We want our clients to do and have access to the tools that wealthy people have access to, and that's what we use. And so the last few years reminded everyone that bonds can lose value too, so especially when interest rates rise. So retirees need to rethink what safety really means.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnan and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.